Rich people invest with intention, not emotion. They understand that money must be directed with purpose. Every dollar has a job. Instead of reacting to headlines or trends, they follow structured plans. Wealth is rarely accidental. It is built through consistent decisions repeated over decades, not days. They focus on ownership, rather than spending on liabilities that lose value. They acquire assets that generate income or appreciate over time. Businesses, stocks, real estate. These are tools of leverage. Ownership produces cash flow. Cash flow builds independence. Rich investors think long-term. While others chase quick profits, they commit to strategies that may take years to mature. They understand compounding rewards patience. Short-term volatility does not shake them. Because their vision extends far beyond temporary movements, they diversify intelligently. Instead of putting everything into one opportunity, they spread risk across multiple assets. Diversification protects capital from unexpected events. Protection ensures survival. Survival allows compounding to continue uninterrupted. Most importantly, they control emotions. Fear and greed influence markets daily. Rich investors build systems that prevent emotional decisions. Automation, clear rules, and disciplined allocation protect them from reacting impulsively. Discipline preserves wealth. Rich people increase investments before increasing lifestyle. When income rises, they raise their savings rate first. Others upgrade cars, homes, and habits immediately. The wealthy expand assets first and expenses later. This single shift accelerates growth dramatically over time and strengthens financial security. They understand leverage. Instead of relying only on their own labor, they use capital, businesses, and systems to multiply results. Leverage allows money to work independently. Time becomes an ally instead of a limitation. Without leverage, growth stays linear. Wealthy investors study risk carefully. They do not avoid risk completely, but they calculate it. Every opportunity is evaluated based on probability and downside protection. Preserving capital is always the priority. You cannot compound what you lose permanently. They value cash flow more than appearance. Owning income-producing assets matters more than looking successful. Quiet wealth often replaces visible luxury. Financial strength does not need public validation. Stability matters more than status. Rich investors track their numbers constantly. Net worth, returns, expenses, allocations, everything is measured. What gets measured improves. Clear data allows rational decisions. Without clarity, money drifts. Without direction, and opportunities remain unnoticed. Rich people build investment habits that run automatically. They remove the need for daily willpower by setting recurring transfers and predefined allocations. Automation protects consistency. Consistency protects compounding. While others rely on motivation, the wealthy rely on systems that function regardless of mood. They separate consumption from investment clearly. Spending money and wealth-building money are never confused. This boundary prevents emotional decisions from touching long-term capital. Clear separation creates discipline. Discipline protects growth over decades. Wealthy investors focus on percentages, not just amounts. They understand that improving returns by even 1% over decades can create massive differences. Small advantages compound into large outcomes. Precision matters. They invest during uncertainty. While many wait for perfect conditions, rich investors act when assets are undervalued. Fear in the market often creates opportunity. Courage combined with analysis produces strong long-term gains. They continuously educate themselves. Financial knowledge evolves, and so do strategies. Learning reduces costly mistakes. Instead of avoiding complexity, they master it gradually. Knowledge strengthens confidence and improves decision-making over time. Rich investors prioritize asset allocation over stock picking. They understand that overall portfolio structure determines most long-term results. Instead of obsessing over single investments, they balance exposure across sectors and asset classes. Structure creates stability and consistent performance. They protect downside aggressively. Limiting catastrophic loss is more important than chasing extraordinary gain. A major loss requires enormous recovery. By avoiding deep setbacks, they maintain steady progress and protect the power of compounding. Wealthy individuals think in decades, not quarters. They measure performance across long cycles. Temporary downturns are viewed as normal phases. Emotional reactions are replaced with strategic adjustments aligned with long-term goals. They reinvest returns consistently. Dividends, profits, and interest are redirected back into assets, Reinvestment accelerates exponential growth. Spending gains too early interrupts compounding and slows financial momentum. Rich investors understand taxes. They structure investments efficiently to minimize unnecessary losses. Tax planning preserves more capital for reinvestment. Over decades, tax efficiency significantly increases total wealth accumulated. Rich people value liquidity strategically. They keep enough accessible capital to seize opportunities quickly. When markets fall or unique deals appear, they are ready to act. Others hesitate because their money is disorganized. Preparation creates advantage during uncertain moments. They avoid emotional attachment to investments. If data changes, they adjust logically. Pride does not control decisions. Admitting mistakes early limits damage. Flexibility protects capital and allows adaptation without panic. Wealthy investors understand opportunity cost. Every dollar spent or invested has an alternative use. They evaluate decisions based on potential long-term return, not immediate satisfaction. This mindset sharpens financial judgment. They focus on building multiple income streams. Relying on one source creates vulnerability. Diversified income strengthens resilience. When one stream slows, others continue producing cash flow. Rich people treat investing like a responsibility, not a hobby. It receives time, attention, and structured plan. Casual participation produces casual results. Professional mindset produces professional outcomes. Rich investors analyze data before acting. They review fundamentals, trends, and financial statements instead of relying on rumors. Decisions are based on evidence, not excitement. Careful evaluation reduces unnecessary risk and increases probability of success over time. They accept volatility as normal. Market swings do not surprise them. Instead of reacting emotionally, they prepare in advance for fluctuations. Preparation removes panic. Calm behavior during turbulence protects long-term strategy. Wealthy individuals prioritize scalability. They invest in assets that can grow beyond their personal effort. Scalable opportunities multiply returns without requiring equal increases in time. Scalability accelerates wealth creation. They delay gratification deliberately. Immediate rewards are sacrificed for future freedom. This discipline separates investors from consumers. Delayed gratification fuels compounding and strengthens financial independence. Rich people review portfolios regularly, but not obsessively. Strategic adjustments replace impulsive trading. Balanced oversight maintains alignment with goals without disrupting long-term growth. Rich investors think in terms of probabilities, not certainties. They know no investment is guaranteed. Instead of searching for perfect outcomes, they look for favorable odds. When decisions are repeated with positive probability, results improve over time. Consistent advantage beats occasional luck. They build margin of safety into every decision. Buying below intrinsic value or keeping reserves reduces exposure to unexpected shocks. Margin protects capital. Protection keeps compounding intact during difficult periods. Wealthy people separate noise from signal. News cycles create constant distraction. Instead of reacting to headlines, they focus on long-term fundamentals. Ignoring noise preserves clarity and prevents unnecessary trades. They commit capital gradually. Rather than investing everything at once impulsively, they scale into positions strategically. Gradual allocation reduces timing risk and improves discipline across different market conditions. Rich investors surround themselves with knowledgeable advisors and networks. Learning from experienced individuals shortens the path to competence. Strong networks provide insight, perspective, and opportunities unavailable to isolated investors. Rich people define clear exit strategies before they invest. They know under what conditions they will sell, reduce, or increase positions. Planning decisions in advance removes emotion later. Clear rules prevent panic selling and reckless holding. Strategy replaces impulse. They focus on long-term value creation, not short-term price movement. A strong business with growing earnings matters more than daily volatility. Price follows value over time. Patience allows value to be recognized. Wealthy investors keep personal finances strong before taking major risks. Low debt and emergency reserves provide stability. Stability allows confident decision-making during uncertainty. Weak foundations force emotional reactions. They understand that discipline is more important than intelligence. Many smart people fail because they lack consistency. Repeated, boring actions often outperform brilliant but inconsistent moves. RICH people evaluate investments based on fundamentals, not popularity. Just because something trends does not mean it creates value. Independent thinking protects capital and improves long-term results. Rich investors automate contributions to their investments. Monthly transfers remove decision fatigue and prevent skipped months. Automation ensures consistency, which is the foundation of compounding. Discipline becomes effortless when systems handle execution. They embrace losses as learning opportunities. Small setbacks are analyzed for mistakes and lessons, not punished with panic decisions. Accepting loss reduces emotional overreactions and strengthens future judgment. Wealthy people maintain flexibility in their portfolios. They adjust allocations gradually to reflect changing goals, risk tolerance, and market conditions. Flexibility prevents stagnation without sacrificing long-term strategy. They avoid chasing hype or trends. Short-term excitement often leads to buying high and selling low. Patience and rationality outweigh impulsive actions. Waiting for solid opportunities protects capital. Rich investors understand that money is a tool, not a status symbol. They invest in assets that generate returns rather than in items that depreciate. Functional decisions create real wealth over time. Rich people continuously educate themselves about investing and finance. They read, analyze, and learn from experience. Knowledge reduces costly mistakes and increases confidence. Continuous learning compounds like capital, strengthening decision-making over decades. They avoid emotional attachment to individual investments. Pride or fear does not influence decisions. Objective evaluation ensures that underperforming assets are corrected and promising opportunities are fully utilized. Finally, rich investors focus on building systems, not chasing luck. They create habits, plans, and routines that ensure steady growth over time. Discipline, consistency, and long-term thinking, repeated daily, separate wealth builders from everyone else.